There's a pitch making the rounds right now that sounds almost too good to be true. Stop giving your money to banks. Stop trusting Wall Street. Use a life insurance policy to become your own banker, grow your money tax-free, and borrow against it whenever you want. It's called infinite banking, and if you've spent any time on financial YouTube, you've probably seen it. The people behind this strategy will tell you it's what the wealthy have been quietly doing for decades. The people against it will call it overpriced, overhyped, and sold almost exclusively by agents who earn enormous commissions pushing it. So which one is right? Today we're going to answer that by doing something most of those videos never actually do. We're going to run the real numbers. Same dollar amount, 2 different paths, 30 years, and we'll see exactly where each one ends up. Let's start with a guy named Jordan. He's 32, earns around $70,000 a year, and he's genuinely trying to do the right things with his money. He's got a bit in his 401k. He's been meaning to open a Roth IRA, and then one evening he watches a video about infinite banking and something clicks, or at least it feels like it clicks. Here's how the pitch works. You take out a whole life insurance policy. Unlike term insurance, which is pure coverage and expires after a set period, whole life insurance never expires, and it has something built into it called cash value. Every month, part of your premium goes toward the death benefit, part goes to the insurance company, and the remainder accumulates inside the policy as cash value. Over time, that cash value grows. And the key selling point is this: you can borrow against it at any time. Want to buy a car? Borrow from your policy. Want to put a down payment on a rental property? Borrow from your policy. Instead of sending interest to a bank, you pay it back to yourself. The concept is called infinite banking, and the way it's framed, it sounds like a cheat code hiding in plain sight. Jordan watches 20 more videos. Every single one tells him the same thing. This is the strategy the wealthy never talk about publicly. This is what they never taught you in school. So he reaches out to a specialist. The agent is sharp, confident, and sits Jordan down with a glossy illustration showing his cash value climbing upward, year after year, for decades. Before Jordan signs anything, let's look at what actually happens underneath the surface. When you pay your monthly premium on a whole life policy, that money doesn't land in a savings account with your name on it and start compounding. It gets divided. A portion covers the insurance cost. A portion covers the company's overhead and operating expenses, and whatever is left over goes into your cash value. In the early years of the policy, that remainder is thin, very thin, because the insurance company isn't the only one getting paid up front. The agent who sold you the policy typically earns a commission somewhere between 70 and 110% of your entire first year's premium. On a $9,000 annual premium, that's potentially $9,000 in commission, paid out before your cash value barely registers. This is not a glitch, it's how the product is structured, and the infinite banking community knows it, which is why properly designed policies use something called paid-up additions, or PUAs. These are supplemental contributions on top of your base premium that flow almost entirely into cash value, bypassing much of the commission drag. A well-structured infinite banking policy might route 60 to 80% of total contributions through PUAs. It helps. But it doesn't eliminate the early losses. Now let's put Jordan's real numbers on the table. He decides to put $750 a month into this strategy. That's $9,000 a year. On a $70,000 salary, that's roughly 13% of his gross income going into one policy. The agent sets it up correctly, with maximized paid-up additions, the works. After year one, Jordan has paid in $9,000. His cash value is somewhere around $6,300 to $7,200. Right out of the gate, he's down 20 to 30%. After year 3, he's paid in $27,000. His cash value is probably around $22,000 to $24,000, still underwater. It takes until somewhere between year 5 and year 7 for the policy to break even, meaning his cash value finally catches up to what he's actually contributed. By year 10, Jordan has put in $90,000. His cash value, with dividends reinvested at the top mutual insurance companies currently paying around 5.75 to 6.6%, is roughly $85,000 to $100,000. By year 20, he's contributed $180,000. Cash value lands somewhere between $210,000 and $260,000, and by year 30, he's put in $270,000. His cash value could reach $400,000 to $500,000, plus there's a death benefit growing alongside it. Now that's real money. He put in $270,000 and ended up with potentially $400,000 to $500,000. That's genuine growth, and it's hard to argue otherwise. But here's the question almost nobody in those videos wants you to ask. What if Jordan had done something simpler with that same $750 a month? Let's run the other paths. Jordan buys a 20-year term life insurance policy for about $30 a month. That gives him $500,000 in death benefit coverage. His family is protected. Done. Now he takes the remaining $720 every month and puts it into a low-cost S&P 500 index fund. No agents, no commissions, no policy illustrations, just consistent, boring investing. The S&P 500 has averaged roughly 10% annually over the long run. We'll use 8% to be conservative and account for real-world conditions. After year 10, Jordan's invested about $86,000. At 8% annual growth, his portfolio is worth somewhere around $130,000 to $135,000. Compare that to the whole life cash value of $85,000 to $100,000. After year 20, he's invested roughly $173,000. The index fund portfolio is now worth around $430,000 to $450,000. The whole life cash value was $210,000 to $260,000. After year 30, he's invested about $259,000, and his portfolio is worth somewhere between $1.05 and $1.1 million. The whole life cash value was $400,000 to $500,000. Same $750 a month, same 30 years. One path ends near $500,000, the other ends above $1 million. The gap is roughly double. And that's using conservative numbers. At the historical 10% average, the difference is even larger. Now whole life advocates will immediately push back, and they're not entirely wrong to do so. The cash value growth is guaranteed. It never goes down. The stock market crashes, sometimes dramatically. Your whole life policy never loses ground. That stability is real, and it has genuine value, especially for people who can't stomach volatility. There's also the tax-free growth argument, and again, they have a point. But if Jordan's using a Roth IRA for part of those contributions, that index fund growth is also completely tax-free. And even accounting for long-term capital gains taxes on the remainder, which max out at 15% for most people, the index fund path still ends up significantly ahead. There's also a liquidity angle the sales pitch rarely mentions. If Jordan hits an emergency and needs money fast, he can sell shares from his index fund and have cash in his account within a few days. No applications, no repayment schedule, no interest charges. With the whole life policy, he's technically borrowing against his own money and paying 5 to 6% interest for the privilege of accessing it. Yes, his cash value keeps compounding in the background while the loan is outstanding, but the dividend rate and the loan interest rate are close enough that they largely cancel each other out. You're not getting free money, you're renting access to your own money. There are a few things the infinite banking sales pitch consistently glosses over. The agent commission we already covered, but it's worth sitting with for a moment. On a $9,000 annual premium, the agent potentially earns close to that entire amount in year 1. That comes directly out of your early cash value. The person selling you this strategy has the most financial incentive in the room. Then there's the lapse rate. Industry data shows the average whole life policyholder surrenders their policy around year 7 or 8. That's the majority of buyers walking away before the policy ever reaches the performance window. They pay for years, build minimal cash value, and then life happens. Job loss, medical bills, a bad year. They can't keep up with a $750 a month commitment and they surrender. The insurance company keeps the profit. Think about how tight that margin is on a $70,000 income. One financial disruption and the whole structure falls apart. And every dollar Jordan locks into this policy is a dollar that isn't earning his 401k employer match, which is an instant 50 to 100% return on that contribution. There is no financial instrument on earth that beats free money from an employer match. So does infinite banking work for anyone? Yes, genuinely, but probably not for the people being sold this strategy most aggressively online. If you're already earning $250,000 or more per year, you've maxed out your 401k, fully funded your Roth IRA, and you're still holding money in taxable accounts looking for somewhere else to put it, then whole life insurance becomes an interesting option. At that income level, the monthly commitment is a small fraction of your earnings. You've already captured all the easy wins, and for high net worth individuals, the estate planning advantages are real. The death benefit passes to heirs income tax-free. Business owners use the cash value strategically for liquidity and funding without selling off assets. These are legitimate, documented uses. The strategy is real, it works. The problem isn't the product. The problem is the audience being targeted. A 32-year-old making $70,000 a year, who hasn't maxed their employer match, who doesn't have a Roth IRA, who is still building their financial foundation, that person is not the right candidate for infinite banking. Selling them this strategy before they've captured those foundational returns isn't financial education. It's a commission-optimized sales pitch wearing educational clothing. So what should Jordan actually do with that $750 a month? First, a term life policy. $30 a month gets him $500,000 in coverage, family protected, done. Second, contribute enough to his 401k to capture the full employer match. Third, max out a Roth IRA. For 2025, the contribution limit is $7,000 annually for anyone under 50. Tax-free growth, tax-free withdrawals in retirement, no policy loans required. Fourth, take whatever remains and put it into a low-cost S&P 500 index fund through a regular brokerage account. Simple, consistent, cheap. If Jordan does this from 30 to 60, he ends up in an exceptional financial position. And if his income grows significantly over time, say he's earning $200,000 or $300,000 in his 40s, then the whole life insurance conversation becomes worth having, not as a foundation, as an addition to a foundation that already exists. Infinite banking isn't a scam. The concept is legitimate. The insurance companies behind these products have survived the Great Depression, 2 world wars, and every market crash in between. The product is stable, but the way it's being marketed makes it sound like a universal wealth-building solution for anyone watching a finance video at midnight, and the math does not support that. For most people at average income levels, your dollars have better places to grow, faster places, cheaper places, places that don't require a 30-year commitment that most people statistically never finish. Know the difference between a strategy that's designed for your financial situation and one that's designed for someone else's. That distinction is worth more than any policy illustration.